Welcome back to the channel. I'm Foreman, and today we're going to be talking about the UK stocks that I'm buying right now, including a new addition to my dividend portfolio or my self-invested personal pension. And if you like the video, please share one of these to help beat that YouTube algorithm. According to Google Finance, the FTSE 100 is up 0.92%, the FTSE 250 is up 2.12%, and the S&P 500 is up 1.99%. My portfolio has managed to outperform the markets this week through quite a swing of positive news that certainly pushed the share price of some of my companies up. I don't expect this to be long lasting, but some of the news that has been said has certainly de-risked the investments and certainly adds to the quality of them. So there is some certain medium to longer term drivers of share price. My portfolio is up 3.66%, and at the moment stocks remain favourable, or at least higher risk assets. We're in a low interest rate environment, and in a low interest rate environment it's very much the case where people are looking for greater risk. They know that if they park their money at a bank account getting 0.1% returns on their cash, they're not going to make much money from this. So what they do is they look at the stock market. They go, yeah, okay, stock market's cool. I can get some dividend income, or I can chase these penny stocks, or furthermore, I could invest in cryptocurrencies. This is a typical trend. I'm not saying that this is exactly what every single person will do, because quite frankly, that's ridiculous. And I don't have that level of knowledge. The main thing is that this week, the Bank of England has remained unchanged on their policy when they were looking or reviewing interest rates. According to them, of the 9 people that voted, 2 of them voted in favour for an immediate rise of interest rates to 0.25%, and 3 wanted the central bank to end its quantitative easing programme of asset purchases right now. This feels like a very much mixed bag to me, because I'm seeing the Bank of England going, right, you know what, 2 want interest rates to rise. They're a little bit concerned about inflation. Perhaps keeping interest rates unchanged makes it look like the economy is in a more fragile state than one may anticipate. And so certainly there are some concerns there. And this has definitely impacted like the UK banking stocks. Those stocks have certainly dropped down a bit, and we have seen the pound weaken against, for instance, the euro and the US dollar. This makes sense because now people are like, okay, well, is the UK economy a little bit more fragile? Okay, we're going to move away from the pound. I can't really justify these trends as to why they're happening, because quite frankly, the pound moving up and down does not impact me as long as my investments are purely predominated in the pound, and whether it goes up or down, it really should not have a large impact to my investments. At the end of the day, I plan on retiring with pounds and spending it in the UK. Interestingly as well, we did see here on the Bank of England update that they are certainly very convinced that we are going to be tightening the policy. The Bank of England have said that an immediate rate rise will certainly be coming soon, and at the moment inflation is very high. For instance, predictions of inflation reaching 5% next spring is certainly a high and quite scary amount, and so interest rates will likely have to be tightened very soon, and in fact this could be the case for the future. We don't truly know if interest rates are going to rise. I personally feel, in my own speculation, that interest rates are going to remain very low for a long time. I don't see the advantage really of raising interest rates, although the end of quantitative easing programs such as asset purchasing plans in the UK could certainly be a concern, and tightening of quantitative easing can certainly lead to valuations in the stock market in terms of multiples being squeezed. We may see some volatile markets with the times to come, but then we could also assume that the markets have already priced in the Bank of England's judgments, and so seeing this may not have had a great overall impact at all. After all, they're not directly buying stocks, but they are buying debt, and that debt, obviously at the moment it's very cheap to have debt. When that starts to become more difficult, things start to struggle a little bit more, and you can see how this really can cycle out of loop if obviously it is remained or isn't looked at very carefully. The economy is a very complex thing, and I'm not even going to pretend like I can understand it. Algo Blockchain had quite a lot of news this week for the Q3 2020 results and conference call. Shares are up 1.34%, or according to my Freetrade app, they're down about 5%. Regardless, the main thing here is that they have generated record revenue of £19.3 million. I mean, we could see this coming already. We've seen the monthly updates. This really doesn't add too much overall to this, and they're still on about how they're breaking ground on its renewable energy 200 megawatt cryptocurrency facility in Texas. It's a lot of the same repeated things. I don't really see anything of much here, other than the fact on September 30th, Argo did execute a purchase agreement for 20,000 Bitmain Antminer S19J Pro machines for the mining facility it is building in Texas. Apparently, they're expected to be delivered during quarter 2 of 2022 and would bring their total hash rate capacity to approximately 3.7 exahash, which is more than 3 times the current mining or hash rate capacity for the company. Furthermore, some inside information was revealed via RNS, and this is very interesting indeed. Apparently, they held a meeting with a gentleman named Anthony Coyle in which they discussed Argo Blockchain's business. This person then created a report on the matter, and obviously this wasn't a good thing, so they immediately needed to go, right, this is exactly what's happened. Interestingly, that apparently Mr. Coyle had written that Argo claimed a 25% uplift in hash rate resulting from the use of immersion cooling technology. If they're able to really successfully control this and take advantage of this, this would definitely add another unique selling point to the idea of Argo blockchain and make them look a lot more favorable to or compared to their competitors. However, Argo say they have not got such data to make such a claim, etc. They're kind of covering their backs a little bit here, but they are saying that they do think immersion technology can allow mining machines to run at greater sustained processing speeds and extend the life of older machines, or that are becoming or no longer profitable, that use conventional air cooling technology. So that certainly is a chance, or perhaps somewhere they can invest more capital expenditure in the future, just so they can really take more efficiency out of their mining machines. Although at the same time, Argo blockchain is a very capital intensive business. We have got a certain amount of cash on the balance sheet at the moment, but truly, how long is that going to last? Because quite frankly, once they spend that cash, they're going to want more growth opportunities. Notably, when they're on about spending cash, they're on about the idea of this Texas facility. They're talking that the total cost to build and kit out an 800 megawatt facility in Texas could be 1.5 to 2 billion US dollars. I believe Argo blockchain's market cap as of right now is 500 million pounds, and I believe the cash they raised from the Nasdaq listing was something like 100 million pounds. How are they going to really get that kind of money to build an 800 megawatt facility? Must be a much longer term goal. And that may mean that shares may push up in this time period. And if shares push up, they may look to dilute further. Again, this is a company that is going to be constantly trying to bring up debt, use strategic growth in terms of trying to grow the business as fast as possible. If it means diluting shareholders, taking up cheap debt facilities, it is all a very risky sort of game. Very interesting though, and I do like this the most, that they are looking at the company's strategy of evaluating cryptocurrency other than Bitcoin, and that they can find revenue from such alternative currencies that can comprise up to 20% of total revenue. They would find that acceptable, and that may be a good thing for the future. Obviously, the equipment and the requirements to mine different cryptocurrencies obviously is going to change, and those machines that you have bought may not be as effective with another cryptocurrency. However, I do believe in diversification here. Mining only Bitcoin may not be the one, and so I will be interested to see what they may see has value. After all, you could certainly have some good diversification here, and then you could go, okay, if we're bullish on Bitcoin, we could sell the 20% proceeds of the total revenue from an alternative currency. We can use this to keep generating cash and then use that to reinvest back and buy more equipment. Or we could then just buy more Bitcoin with that, which quite frankly, I hope they don't do, because that's what they are doing with Zcash. And quite frankly, I feel that buying more Bitcoin, even though it could be a lot higher over the longer term, isn't a smart way for growth. The big news this week is Boohoo. Boohoo shares are up 4.7%. I bought 136 more shares this week, equivalent to roughly £250. They had that US court case with the lawsuit or the fees totaling the idea of being $100 million. This was a very sensationalist media article, and I called out upon that before. Originally, the claim was roughly £73 million, but in Boohoo's latest accounts published in September, it only made a provision of £19.1 million for all legal claims. This was the class action lawsuit in the US, in which a gentleman had bought $200 worth of clothing, stated that actually they never intended to sell it at their original retail price, that they are constantly doing a 30 to 40% sale, meaning that that isn't actually reflective, and in fact it's misleading. So them having this 30 or 40% sale is misleading to customers, and basically it doesn't look very happy for Boohoo, because overall in the court it doesn't look like they're doing well. I believe they had a bid to overturn the court case which failed, but now there is some good news, and that is that they have come to some agreement on a settlement, on having a preliminary settlement, I believe. And this doesn't mean the court case is over by any means. However, it does mean both parties are going to be working together and trying to find a good balance. And quite frankly, this is probably the best outcome Boohoo could have. I think they really need to reflect back on their strategy. I love the idea of having constant sales, but you've really got to mix things up, because people do start to realize, oh, 30, 40% off this week. Yeah, it was that last day. Oh, it was that Thursday. It's just always that sale. I do like the business model where, yes, we'll sell a product at full price when it's new and it's fresh, it's fast, everyone is interested. We'll sell that at full price for a quarter of a year, and then after that you then look, okay, right, we've sold that at that price, now we'll start discounting it, we'll start adding it to promotions, sales, and I think it's a very good business model. But obviously they need to be careful when they are retailing in other countries. They need to make sure they are complicit with the law, and I think this is a concern really that could impact any retailer, in particular online retailers across the world. But Boohoo having this means that they are a much stronger beast today than they were before. Mainly because they had their ESG concerns. They had their supply chain issues. They invested a lot of capital in order to deal with this. They've now got probably the best supply chain in the country, or much further than other listed companies, because quite frankly, they've had the most scrutiny. They've been told, hey, look at that, look what you've done. You've got issues in your supply chain, invest money and deal with it. And now that they've done that, obviously to get rid of this media backlash, they've also put themselves or their company in a much stronger position. And the fact shares are trading at something like £1.93 a share is absolutely baffling. This is a very, very undervalued stock, and in fact I think this has the most upside in the medium term of all the stocks I hold. Speaking of stocks I hold, I actually bought a stock that I had held before in the past. I've added this to my SIP portfolio. This stock is LSEG, a London Stock Exchange Group. I've only bought one share, but shares were trading at a very attractive price of roughly £70 per share. I think I originally had bought shares of LSEG, or back when they were LSE, before they had combined with Refinitiv, so for something like £83. I remember selling that at roughly 88 or maybe 90 odd pounds, and then shares had crashed. The Refinitiv hype, or at least corrected. The Refinitiv hype wasn't as big as it may have seemed. There was a lot of hype towards it, pushing shares up before it, and then when the actual green light came through and the acquisition was good, shares flopped. I think they are a very interesting company with a very durable moat. It's not every day you can just create a stock exchange out of thin air and then have that loyalty behind it, which you would have with your brand, or really any company can't really push into this space. There's definitely high barriers to entry, and they've also got that data behemoth, which is Refinitiv, and all of that data is obviously at the moment being priced at a very competitive price so that everyone has fair access to this data. But over that longer term, that's going to be a very big revenue generator for the company, and quite frankly, I like it in my dividend portfolio. I think this is a stock, whilst yes, the dividend yield is low, I think quite frankly that I'm happy with this. I'm just going to let this sit in the portfolio. It has some growth potential. Yes, it is something like a £40 billion company, and yes, this is a lot bigger than what I typically like to invest in, but I feel that I'm just going to let it run, because quite frankly I worry too much about the market capitalization of companies, when in reality I should be just looking at the underlying financial growth. If this company is able to grow by 20% each year on their earnings and revenue, it doesn't really matter of their size, because they're going to keep growing, and that compound growth there is going to generate substantial returns on investment, providing you are aware and are careful of obviously valuations, and you don't buy a very, very expensive valuation where price to earnings is something like over 1,000 times, despite obviously having high growth of earnings in the last year or so, because obviously it could be an inflated price to earnings if it's trailing 12 months. In the case of the idea where, oh no, they've had a struggling quarter and their earnings have cut in half, it's not inflated like that. I've also got Daniel Group still. I've not bought any more shares. Shares have climbed by 3.74% this week. This is one that I'm bullish on. I am confident with the business model. I like it. I think they've got growth potential, but they're also slow and steady. Predictable financial growth is what I like. This can sit in my portfolio and just generate income for me. It can sit there and do its thing. At the moment, in my self-invested personal pension, roughly the total amount in there is about £214. Overall, I've got £20 left of cash. I'm going to transfer in a pension in the next month or two, which will add another £800, but nothing massive. I hope just to build up a passive income stream of dividend income, and then in that portfolio we'll have some interesting things to see, and we can tally up and see how the dividend growth is over the longer term. And speaking of dividend growth, at least dividend income, Games Workshop this week, my second largest position in which I hold 75 shares, paid out a dividend of £17.75. Obviously, this was a large cut that it had done a few months ago. I understand this. I think this is a great move because they're only reinvesting, or at least distributing truly surplus capital to shareholders in the form of dividends, and that's a great sign because right now they've now got more money on their balance sheet and they're going to put that money back into the company and hopefully grow further. There is some discontent amongst the fan base with the Jeffrey analysts saying there is concerns because the fan base of Warhammer are certainly feeling disconnected from the company in the way that the company has really pushed in and said, hey, you aren't allowed to create content on Warhammer, we're blocking it. This is our intellectual property. I think is a terrible way of dealing with the matter, but I do feel that if they are aware of this, and hopefully they do become aware of this, that they are a very quality company. Although shares did drop in the last 2 weeks, I've not been buying more. I think Boohoo is of higher value, and furthermore, at the moment, as I say, the story is slightly changing. It's not a reason to sell, it's not a reason to buy, it's a reason to continue holding, unless you can feasibly see as to why the customer base of Warhammer is going to adapt, or they're going to start becoming fans again and really like the company. It certainly is a concern. I'm hopeful over the longer term, but I can't invest just on hope, and so I'm going to buy what I know best. And at the moment, that's Boohoo. The underlying financial and revenue growth overall is something I can see, and it doesn't seem like there's discontent amongst the fan base, at least not in terms of the clothing products, more or less the ethical, social and governance concerns that have been really whisked about for the last year and a half. If you'd like to sign up to my stockbroker Freetrade, you can get a free share worth up to £200 when you use my link in the description down below. And if you'd like to see my free UK stocks, that's 4 free UK stocks to buy right now, then click the card at the top right of the video. Have a fantastic weekend.